Well, I'd love to stand here and tell the American people we can cut your taxes and we can increase spending and everything's going to be just fine. But I can't do that because I'm here to deliver a dose of reality. This bill dramatically increases deficits in the near term, but promises our government will be fiscally responsible 5 years from now. Where have we heard that before?
Friday, May 23rd, 2025, Monaco 64, home of alternative economics and contrarian views. Good morning, Clive.
Good morning, Mario. I can't see your sofa and I can't see Rudy.
Oh, yeah, Rudy's right here behind me in this bed.
Okay.
We should be getting back to this study very soon. So today we're going to cover this, in my opinion, I don't know what your opinion is, Clive. The biggest event this week for me in terms of the markets, the economy in the US and around the world, and gold and bonds is this budget from this big, beautiful bill that came out, and we will cover that. But before that, talking about the my study and the fact that I'm not in the usual place. I always remember you talking about when people ask, "What should I?" I've got this amount of money. Should I pay off the mortgage? Should I buy gold? And one of the things you told people is that you have to upkeep your home because it's a lot easier, I guess, to sell your house if it's in good condition. And the other thing, Clive, that I see it as is that if I wait 12 months or 24 months to do the work, the cash in the bank is going to be worth a lot less. I mean, we've seen CPI this week in the UK come out at 3.6%. And even if you're able to get 3.5 or 4% for an ISA, the tax that you pay, you're going to be losing purchasing power. So yeah, maybe you can talk a little bit about that, and then we'll move over into the big, beautiful budget.
I think one very clever way of saving money and keeping it out of the hands of the banks and the government is to put it into your own home. And that can be a home extension or home improvement, or quite simply what they call renovations, which is when you repaint the walls, redo the floors, and do all kinds of work in your house. And obviously, Mario, I'm very pleased to see that you're taking some of my advice here. So I
Yeah.
hope many of your other listeners will do the same thing. But perhaps I just talk about one thing which a lot of people don't quite get. And it's this: when you spend money on your home, the increase in value is likely to exceed what you have spent. And the reason for that is more related to the mortgages, or the way banks and other financial institutions work when you're asking for a mortgage. Now, it varies per country, but just for simplicity, I'll assume that, let's say in the UK, when you borrow money from a bank, you need to have 10% in cash. In Switzerland here, it's 20% in cash. That's the law. Basically, the bank can't lend you money unless you stump up 20% of the house purchase. But I'm assuming it's perhaps a little bit more lenient in England. And
Yeah.
let's
Wow.
call it 10%.
They're talking about having 100% mortgages for some first-time buyers. But anyway,
Yeah.
continue.
Let's, I mean, that can happen, but let's assume that it's a 10% requirement that you've got to come up with cash. So what would that mean? It'd mean that if someone is buying a house for £500,000, and that's the purchase price, he needs to have 50,000 in the bank to put down the initial payment, which is required by the bank, so he's got some equity in the house. But if the house, let's say the house needs another 50,000 of renovations, he looks around, the kitchen's a bit shabby, the walls are a bit old, the floor needs to be replaced, perhaps it needs rewiring, and putting all that together might cost you another 50,000. Then he's going to buy that house. If the price is 500,000, he's going to say, well, I need the 50,000, but I need another 50,000 to do the renovations, and I haven't got that. So I can't afford the house because I haven't got the 100,000 necessary. I've only got 50,000. So what if the house was reduced to 450,000 to take account of the 50,000 of renovations. Well, then he needs 45,000 for the 10%, plus he still needs the 50,000, making 95,000. So you basically, if you haven't done the renovations, you've basically knocked out of the market a whole slew of buyers who say, I'll only buy a house if it's in good condition, or if I've got the money, which I don't have, to do the renovations. So much better you do the renovations. So a £450,000 house could in fact be sold for 500,000 with the 50,000 of renovations, and probably a bit more, because it's obviously worth more with the renovations. So my message here is, if you don't do the renovations, if you don't do the improvements, if you don't do the refreshing of your home, you will lose some potential buyers. And if you lose some potential buyers, it means you won't get as good a price as you would have got if you've had it done. Does that make sense to you, Marion?
It does. It does make sense. It does. And yeah, we're having renovations done, not extensions. And yeah, it's worth it. And because the last time we had it done was a major renovation is when we moved here 10 years ago. And to be honest, the people who did it were not very good. So unfortunately, but talking about being fiscally responsible in terms of houses, can we say the same thing for Uncle Sam and the big beautiful Bill, Clive? And before I let you chime in, I just want to share this with you and the viewers. And yeah, I think this is really significant. What this is a Republican congressman from Kentucky. His name is Thomas Massey, and he's very conservative. He's like the Ron Paul modern day, Ron Paul of the younger generation. So listen to what he said.
For 90 seconds. Well, I'd love to stand here and tell the American people, we can cut your taxes and we can increase spending and everything's going to be just fine. But I can't do that because I'm here to deliver a dose of reality. This bill dramatically increases deficits in the near term, but promises our government will be fiscally responsible 5 years from now. Where have we heard that before? How do you bind a future Congress to these promises? This bill is a debt bomb ticking. Congress can do funny math, fantasy math, if it wants, but bond investors don't. And this week, they sent us a message. Moody's downgraded our credit rating, and the bond investors who buy our debt and finance our debt demanded higher interest rates on the 10-year note, 20-year note, and the 30-year note. What does this mean? Very soon, the government will be paying $16,000 of interest alone per U.S. family. And what are we telling them? Instead of taking care of that problem, we're going to give you a $1,600 tax break. Under the taxing and spending levels in this bill, we're going to rack up, the authors say, $20 trillion of new debt over the next 10 years. I'm telling you, it's closer to $30 trillion of new debt in the next 10 years. Mr. Speaker, we're not rearranging deck chairs on the Titanic tonight. We're putting coal in the boiler and setting a course for the iceberg. If something is beautiful, you don't do it after midnight. I oppose this bill.
My time has expired. Gentlemen.
That was quite interesting, I thought. And this guy, I think, during the election campaign, he was pro-Trump, of course, but he's saying like it is, in my opinion. And I think a lot of people, unfortunately, are so focused on the personality that they're not seeing this danger, in my opinion. He said it's a ticking time bomb, and I agree with him.
So, just for the benefit of your listeners, the big, beautiful bill extends some tax cuts granted to Americans, which were due to expire this year. So, in normal circumstances, those tax benefits or those tax cuts were going to expire at the end of this year, and then the revenue to the Treasury would rise next year because of increased tax payments. That's not going to happen now because the tax cuts have been extended into the distant future. So that has not yet been budgeted for by the Congressional Budget Office because by law they were, up until now, forced to assume that the law would be adhered to, i.e., the tax cuts would end this year, and next year they'd have that extra revenue. And of course, things look pretty bad if you look at the level of debt compared with the GDP. It was set to continue rising ad infinitum under the old rules. But under the new rules, it's going to rise faster. So I've seen on Congressional Budget Office's website, they just in the last day or two put up a list, or rather a spreadsheet, it's an Excel spreadsheet of the impact of the changes to their forecast if this bill gets passed. Now, rather inconveniently, there's many categories which are going to be changing in different categories of tax and this and the other. So inconveniently, they haven't added it up. But I took the liberty of downloading their spreadsheet and adding it all up. So what I can tell you is that the tax or the increase in the deficit next year will be according to their numbers. I'm just looking at the spreadsheet now. It will be next year. It'll be 471 billion bigger deficit than was previously forecast. Now, let's not forget, I think the deficit was something like getting on for 2 trillion, maybe 1.5 trillion.
Yeah.
So now it's going to be 2 trillion. And the year after, that rises dramatically to $560 billion of wider deficit than previously planned. So it's not just the impact of the bigger deficit being caused by these tax cuts, but also, more importantly, as the level of government debt gets bigger, it also means that the cost of paying the interest is rising rapidly. And as that honourable gentleman just pointed out, what did you say his name was? The one who was speaking just now?
Thomas Massey.
Yeah, as Thomas Massey was saying, there's a large impact on the government, which is not really budgeted properly by the Congressional Budget Office because they've assumed a very low rate of interest for the rollover of debt. Because that's what they've been told to expect. But the reality is we're seeing interest rates on the long-dated bonds at the highest level in, God knows, 20, 30 years now, give or take. And currently, as Thomas Massey pointed out, those interest rates have risen again in the last few days, which means that the interest cost on the budget will be, again, quite significant. And certainly those numbers I just gave you will be much higher due to the interest cost, which is not in the Congressional Budget Office's numbers yet because they're still working on a relatively low rate of interest. I think it was something like a maximum rate of 3.1 over the next decade. But of course, we know there's no way you can borrow, no way the government can borrow, or anyone else on the planet can borrow money at 3.1% today.
Yeah, that's wishful thinking, in my opinion. And the other thing about this, it's not a real tax cut, it's just extending a tax cut that's already in there. So that means that people are not really going to feel any wealthier and spend more and buy more stuff and make the economy go up, right? So it doesn't really make that much difference. But the difference it makes is that the government is going to have much bigger deficits, which is already running, Clive, at almost like 7% of GDP. And even Scott Bessent, the Secretary of the Treasury, said that a few weeks ago. He's been saying that, we've inherited this 6% deficit and we're trying to fix it. But how can you fix it if you're going to increase it? And I saw also President Trump, the other day. Someone asked him about that and the deficits, and he said, "Well, we have to spend and run deficits in order to fix the economy." To me, that sounds very Keynesian, and it's the kind of stuff that's been happening for decades. And the reason why the debt is so huge. And Clive, I think foreigners can see this and not only foreigners but U.S. investors as well. Do you really think people are going to be running, chasing long-term treasury paper? I don't think so. If I had billions in the bank, I wouldn't be putting my money, lending it to Uncle Sam long term. But I think the way they're going to get around this is through maybe the Fed will do more QE, or I've also heard that they're gonna like allow the banks to buy more treasuries. Do you remember during COVID, they kind of withdrew this regulation, the statutory leverage ratio, which didn't allow the big Wall Street banks to buy over a certain amount of government bonds. But now I think they're going to strip that apart, and the banks are going to, I think the banks are going to help out because they don't want to see a crisis. But this number came out again recently, Clive, and just for the first quarter, I think, because it comes with a bit of a delay. And these are the unrealized gains or losses on investment securities. That's the blue is held to maturity, and the gold color is available for sale. What it shows me, Clive, the reason why there's so much losses sitting on the bank's balance sheets is because we've had a bear market in bonds and interest rates have gone up. And if the banks start buying more and more treasuries, don't you, that could put the banks in jeopardy. What do you think?
Well, when it comes to the losses that the banks have got on the treasuries, the question is, will these losses get bigger or will they shrink? Now, on that chart, you've got two types of securities. You've got the securities held for sale and the securities held which will be held to maturity. And that's a classification the bank has to make. It has to take each bond and say, well, we really plan to sell this one day, or they say, we really plan to keep this to maturity. Now, they're allowed, when they're keeping it to maturity, they're allowed to count it as worth 100 when it might only be worth 70 or 80 or something like that, which is what the Federal Reserve also does. So that's a little bit of a fiction. But on the other hand, if it's a security held for sale, they've got to market, which means they do have the loss showing. But what happens if, because of these larger and larger budget deficits, the yield on bonds continues to rise, as has been the case despite the interest rate cuts? That means the price of these bonds will continue to fall, and the unbooked or unrealized losses will get bigger and bigger and bigger. And there comes a point where somebody somewhere says, I'd like to withdraw my money to buy whatever. And the bank says, oh, you want to withdraw your money? Well, there's 100 million people like you want to do that. And everybody wants to withdraw their money to buy something. But the trouble is, we've got to sell our bonds, even though we were technically holding them to maturity. So these bonds, which were ostensibly worth 100, when you try to sell them in the market, you don't get 100 for them. You only get 90 or 80 or 70 or 60, depending on how many years there are to maturity. Oops, something's speaking to me. I hope you didn't hear that.
No.
That was my okay. My iPhone was saying, I'm not sure I understand it. Somehow listening to me.
Oh, Siri, was it?
I guess it was. But this is what's called a run on the bank. So if you have too many people taking the money out of the bank at the same time, the banks are forced to sell bonds, and that just exacerbates the problem. Now, I'm not saying that's coming or likely to come, but it's a possibility.
Can I chime in? That's what happened in 2023, wasn't it? When the SVB went bust. A
Right.
few big depositors, they saw the small print and they panicked and they withdrew their money. And it's interesting because from 2022, beginning of 2022, the 10-year yield was like 1.2%. And then by the end of 2022, or October even, it was at 4.2. And and that's when those FDIC data, the losses started like getting really big, and then we had a crisis here of those banks that failed, and the Fed, of course, or the Treasury, they bailed out all the depositors, even those above 250,000, because they were millionaires and they had billions in the bank, or they were billionaires. So that's where we are right now. The 10-year yield, it has come off a little bit today, but it's still above, as you can see here, above 4.5%. I've told the viewers, Clive, the key level is here first, 480. It's around, let's do it this way. It's 480, 480, and then 5%. We'll have to see what happens with that.
You know, I mean, I think the problem of the deficit, the problem of the debt, cannot be fixed. I think the levels have already, and a long time ago, not in the current administration, a long time ago, passed the point of no return, and so it's not the fault of the current administration or the one before that, or the one before that, or the one before that. This is something which has been going on for decades, where each administration has inherited a particularly onerous situation when it comes to government debt. And what do you do if you're on the Titanic and you're sailing towards the iceberg and the bar's still open, and you're going to drown anyway? So what do? You might as well go and have that extra drink. And I think this is what's going on with the government. They're saying, look, it's not our fault this has happened. We can't do anything about it. So what does it matter if we accelerate a little bit by spending a bit more money? There's nothing we can't. There's no cuts we can make to bring this thing back into shape. All we'll do is make the economy worse, or everyone's going to criticize us. So let's give out the free money. Here you are, everybody. Have some free money. Yeah. It's all going to crash anyway. So whether it crashes in 3 years or 5 years, who cares? It'll be somebody else's problem with a bit of luck.
Yeah, and like Thomas Massey said, they're only going to start cutting in 5 years. So it's basically they kicked the can down the road. But if I was on the Titanic, maybe I'd try to get onto a lifeboat, Clive. Maybe like a gold or silver lifeboat, wouldn't you?
Well, if you could buy your way on, there's no amount of money that you wouldn't be willing to pay.
Yeah, and talking about gold, just want to show a chart of gold. Yes, it's been very volatile, as we can see here for the last. This is a weekly chart. The last, let's say, 1, 2, 3, 4, for over a month, and I think it's been like trading between 3,200 and 3,300 or thereabouts. And I think what that does, Clive, it kind of cools down the froth and the moving averages. But what I noticed here this morning, I was looking at this before we started talking, that there's kind of a resistance here, as you can see, around 33.30, 33.28. So I think if we can close the week above this area here, where the bar chart ends, it could be quite positive. Yeah, what about silver? It looks like we're hovering right around that 100 ratio, gold to silver ratio as well. So what's your view on gold short term? I know what your view on long term is, and maybe you want to tell the viewers about it too.
So, I think gold is well supported by central bank buying. I mean, we've seen lots of reasons why gold should have crashed and failed to do so. I mean, to give you a good example, when these tariffs were introduced, everything in the world crashed substantially. Gold went down a little bit, but barely moved, and was very, very quickly back to where it was. So gold was far more resilient than the stock market in the Independence Day tariffs. So gold has held up very well. I think there clearly are buyers there, and we've seen that in the month of May that the COMEX deliveries are 700% higher than they were in the month of May a year ago. And in each month this year, January, February, March, and April, the COMEX deliveries that's people demanding physical or receiving physical bars of 100 ounces each. And don't forget, a contract is it's a 100 ounce contract, so the bars are 100 ounces. We've basically seen at least well over 200% higher deliveries every month, January, February, March, April, than the equivalent month in the previous thing. And in May, it's now 700% higher than a year ago. So out there's somehow, somewhere, a very large buyer or multiple very large buyers who have seen fit to take physical delivery. And there have been lots of theories about who it could be. I mean, people originally said it must be due to Basel III, but we now know that's not the case. So it's not Basel III, which it was, a lot of people were saying gold will be a tier one asset. And LBMA have pointed out that's not actually technically
Yeah,
correct.
Clive, talking about Basel III, just sorry to interrupt you, but VBL Vince, I've had him on the channel. He says breaking, it's 5 hours ago, EU delays Basel III trading rules to 2027 as US deregulation uncertainty persists. So these Basel III rules, they're just like proposals. And it seems like with the US budget, they just kick the can down the road. And it's interesting that the ECB warned a few days ago that the gold market could bring the system down. And I think that's why they've delayed the Basel III, because physical gold would have become a lot more important.
Yeah, so this is effectively a delay on the bank's trading books, where they were required under the rules or the expected rules to have a higher buffer to protect against huge losses. And obviously, if there's a huge loss, it's probably going to be the government who has to put their hand in the pocket. So the idea was that all banks should now have a bigger buffer than they used to have to reduce the risk of then going bankrupt. Well, they pushed those rules into the future now, as far as Europe is concerned, and America wasn't yet implementing them. So the reason Europe has done this is to avoid American banks having an advantage over the European banks, because it means that it would have meant, if it had been implemented, that the European banks would have had to have more capital reserves for their trading book, meaning they might have to reduce their trading, which is an expense on profits.
Yeah.
Now they won't have to.
So basically, it's a race to the bottom in terms of the risk management, I would say, and it makes banks even more risky, I would say, and that's another reason why you should. Well, that's my opinion. I'm not saying you should, but I wouldn't want to have too much of my savings in these banks. But Clive, I think the only way to keep the system going ultimately is for more inflation, more government spending, because if they stop, the whole system comes to a screeching halt. Because, as you know, in a fiat currency debt-based system, if you stop creating debt, you can't pay existing debt. And especially with interest rates and bond yields rising, Clive, that's a problem. And here in the UK, we're not doing anything about the inflation either. We had the CPI numbers this week, and they rose from 2.6 to 3.5. And now the government is giving pay rises to the public sector. I mean, the private sector is suffering, but the nothing wrong with the public sector. The problem is, Clive, that can everyone work for the government? Who, that's the question. I agree there might need to be people working for the government, but if the whole country starts working for the government, who's going to pay for it, Clive?
Well, exactly. I mean, the one man who's still got a job.
Yeah, or maybe the central bank will start printing more and making things even more inflationary. I mean, the Bank of England, I'm sure they knew last week when they cut rates what the CPI was going to be like, but they still cut rates. So another reason to try to do a renovation, extend your house. If you have that cash, that 10,000, 20 or 50 or 100,000 pounds in 2, 3 years time is not going to buy as, is not going to cover the cost of the renovation as much as they do now, or it's you're going to have a lot less sovereigns for that money as well, or Britannias. And talking about gold and silver Britannias, talking about silver Britannias, Clive. Yesterday, I went into the city to meet actually one of the viewers from Australia. He's been watching the channel since 2018. He wanted to meet me. We had a coffee, and we met at the Royal Exchange. Uh, that's where the stock exchange used to be, but now it's like a shop. There's nice shops there. Fortnum and Mason coffee. That's where we were, and it's the
Yes.
yeah, and we were there. And then I went to meet Gold Investments, and I met Simon. I just had a quick chat, and he showed me two boxes, and he said, "Oh, someone just bought 600 silver Britannias." So yeah, that's quite a big purchase, I would have said.
Yeah, 600 times what? Well, I don't know what it is in British pounds. It's 25 pounds or 30 pounds at Britannia, probably.
Probably more now with the VAT and the premium is more like 35. Yeah.
Yeah, that's about what's that? That's going to be about 30,000 pounds, I guess.
Yeah, 600. Yeah. More, yeah, 25,000. Yeah.
Let me put a scenario to you and your viewers, Mario. I want you to imagine that in about 2 or 3 weeks' time, there's a currency crisis in Japan, as an
Oh yeah,
example.
Japan is very the rates are going up there quite a bit, aren't they, Clive?
So, currency crisis, everybody's panicking, and the a decision by the government or the central bank, they close the banks on the Monday. And then by the Tuesday or Wednesday, people in the UK are saying, my God, maybe we're next. And everyone's starting to rush down to the banks and clearing the shelves in the supermarkets. So they close the banks in the UK for an emergency, and the EU does the same thing. And by Friday, it's starting to ricochet into America, and America shut on the Friday. They shut down the banks for an emergency decision what they're going to do. And then the banks stay closed for a week. And after a week, all the central bankers have got together and they've made a decision that because there's a total loss of confidence in the currency, we're back on the gold standard. And we now have in each country a gold yen, a gold dollar, a gold euro, a gold pound. But your old pounds and your old euros and your old dollars and your old yen cannot be changed into the gold pound, dollar, yen, except beyond a certain point. So you might have many, many millions in the bank, but you're perhaps only restricted to having a maximum exchange of maybe £20,000 into the gold pound. So what's the rest of your money worth when you can't spend it and you can't change it into the new currency, which is just being created by the central bankers on this week-long holiday? Well, the rest of your money's worth nothing. So how do you get yourself from this side of the fence to the other side of the fence with more than your minimum of £20,000 in gold, Mario?
Well,
What's the answer?
you own gold, physical
You
gold.
have to buy it now. You
Yeah.
have to buy it now while you still can.
Mm, mm. No, I agree. And I'm going to bring up a chart of the 40-year Japanese government bond yield and see what you think, Clive. And the fact that Japan, I think their debt to GDP, national debt to GDP is almost 300%. And so here you are, just bring this up. That's the 40-year JGB yield, and it reached, I think, almost 3.7 yesterday. And as recently as 2020, it was hovering around zero. So this scenario that you just talked about is very serious because all the big financial institutions in Japan and around the world they hold government debt, and as the yields go up, the prices go down. Maybe you want to talk to the viewers about how that mechanism works. The yield going up and the price going down, and
Yeah, I could.
why it happens, Clive.
Yeah, so I could probably make it nice and simple.
Yeah.
I want you to imagine that you own a 10-year bond. I'm not going to talk about 30 bond, the principle's the same, but let's just do 10-year bonds. You own a 10-year bond, and the interest rate at the moment is, let's say, for simplicity, 4%. That's the yield on the bond, and your bond is trading at 100. But tomorrow, everybody wants a yield of 5%, or they're not going to buy that bond. So what that means is that people are going to want a one extra 1% a year for another 10 years, which means that the bond is no longer going to be trading at 100. It's got to be trading at approximately 90 to allow for the fact that the viewers are only going to get the 4% a year when they wanted 5%. So they've got to get that extra 1% by the price increasing from 90 to 91 through to 100 by 1% a year through to maturity. So what basically would happen when when people demand a higher yield, the bond price will fall. In this case, if it's a 10-year bond and the yield demanded is 1%, theoretically, the bond price should fall by approximately 10%. Now, I know that's not perfect maths because the maths behind it is a lot more complicated, but the general principle is an increase in yield. You multiply that increase in yield by the number of years to maturity, and you get very, very approximately the fall in the price of bonds. So if you have a 40-year bond and the yield falls by 1%, and again, this is not a perfect maths, but in theory, you might see the price of the bond dropping 40 odd percent to get that extra 1% for the next 40 years. Now, it'll be a bit less than that because of the way the maths actually work, because when you pay 60 for a bond, you're also getting the 4% yield on a price of 60 and not on the price of 100. So, in fact, that works out at a higher yield. But the reality is, every time interest rates go up, or rather not interest rates, the yield on a particular bond goes up, the price will go down. The opposite is also true. If the yield on a bond falls, then the price will be rising with it. And one is a function of the other. So the yield is actually on a fixed rate bond, the yield and the price, they move in tandem, but in opposite directions.
And that's why it's such a risk for the banks, because a lot of banks, they hold these bonds as assets on their balance sheet, and they're the bonds that are supposed to be backing your deposits. And that's why it's such a huge problem, and that's why the central banks and governments are going to do everything to try to save this. The only way they know, Clive, is money printing or QE, and I think we're very close to that again. They just need to find some kind of crisis or excuse. And with that, Clive, what are your final words? And yeah.
Well, final words, I think at the end of the day, if they can't pay you, they won't pay you. That's the bottom line. So if we're talking about government bonds, we know they can't pay. So when they do pay you, which might be 10 or 20 or 30 years or even 40 years if you buy this 40-year bond, when they do pay you, it's not going to buy you anything.
That's right. That's how they rip people off. That's why the fiat currency system is such a pernicious system. If the bonds were backed by gold and they were honest, you'd get your ounce back when they paid you back. That was supposed to happen in the 30s, but that's why FDR made it illegal in 1933. They had all these Liberty bonds, Clive. They pushed people to, during World War I to be patriotic and support the cause, and then they ripped them off. But that's par for the course. It's going to happen again, and hopefully you won't be holding the bag. Clive, thank you again, and I wish you a great weekend. And also,
Can I butt in for a quick one, Mario?
Yeah.
Your readers, viewers, should take a look at the chart of platinum, which has just broken out. So maybe there's an article in the Financial Times today. I think it says that the Chinese are all buying platinum jewelry instead of gold jewelry, and that's perhaps why the platinum price has broken through $1,000 for the first time in quite a long time.
Yeah, I saw that this week. Platinum has done well, and I got the chart here, Clive. Yeah, so there you go. There's the spike this week in platinum. I still think, yeah, it looks like there's still a bit of resistance around here, but yeah, it looks a lot better. And at one point, platinum was like worth a lot more than gold back
Yeah,
here. It
it's
was,
gone from 3.7 times the price of gold
yeah.
to less than half the price of gold.
Yeah. So, I mean, I don't have any platinum, but yeah, it looks like a good value proposition. Great, Clive. So, have a great weekend and all of you as well.
Thanks, Mario. But we'll see you on Sunday.
Yeah, Sunday. Hopefully, we'll be back in the study and Rudy will be on the sofa as well.
Great. Bye bye, Mario.
Bye, Clive.